Welcome back to the Neuro Finance Masterclass, everyone. We are officially on day 55 of our 365 Days to Financial Freedom series. Now, yesterday we talked all about buying your assets at a discount, but today we are shifting gears.
Yeah, we are taking this explainer into a much, much darker strategy. We're putting an intense focus on what is arguably Wall Street's most dangerous, high-stakes maneuver. Guys, we are talking about short selling.
So, here's our syllabus for today's rigorous breakdown. Number 1, betting on destruction.
Number 2, the mechanics of a short.
3, the infinite risk nightmare.
4, triggering a short squeeze.
And we'll wrap up with number 5, the architect's golden rule. All right, let's dive right into section 1, betting on destruction. Normally when everyday investors put their hard-earned money into the market, they buy a stock because they actually believe that company is going to grow, right? They want to see the business succeed, hire more people, innovate, the whole 9 yards.
Exactly. But imagine a massive Wall Street hedge fund, one of those institutional whales, looks at a company and thinks, wow, this place is completely terrible. What if they're absolutely convinced the stock is going to crash? Well, they don't just, ignore it and move on to the next stock. They actively bet millions of dollars on its absolute destruction.
Literally. Short selling is the strategy of actively betting money that a company's stock price will crash. It is a highly cautionary, incredibly aggressive maneuver. You aren't investing in innovation or growth here. You are explicitly wagering on failure.
Okay, moving on to section 2, mechanics of a short.
This is where the actual mechanics get absolutely fascinating. Like, how do you actually make a profit when a price goes down? Well, step 1 is that the whale borrows shares from a broker. Notice that key word. They don't own them. They are just borrowing them.
Right. And step 2, they immediately sell those borrowed shares on the open market for cold, hard cash. Step 3, that's the waiting game. They just sit there and hope the price crashes.
Then, step 4, if they're right and the price drops significantly like they planned, they buy back those exact shares at the new, much lower price.
And finally, step 5, they return the shares to the broker and simply keep the difference. It's really the exact same logic as buy low, sell high. It's just executed in reverse order. You sell high first, then you buy low later.
Let's put some hard math to this so it really clicks. Say a massive whale thinks company X, which is currently trading at $100 a share, is totally going to fail. They borrow 10 shares from a broker and immediately sell them on the open market. Boom. They just injected $1,000 in cash directly into their own pocket. But remember, they still owe the broker 10 shares. Now, let's say their bet pays off perfectly and the stock crashes down to just $20 a share. The whale goes back to the market, buys back those 10 shares for just $200 total, and hands the shares back to the broker. So they generated $1,000 initially, spent $200 to settle the debt, and they get to keep that $800 difference as pure profit. Honestly, it sounds like a brilliant, mathematically perfect plan, doesn't it?
But that brings us to section 3, the infinite risk nightmare.
Yeah, that $800 of pure profit looks amazing on a spreadsheet, but we need to radically shift our tone here for a second, because this introduces a truly terrifying reality. When you invest normally, say you buy a stock for $100, your maximum risk is fundamentally capped. The stock can only go down to 0, so you can only lose exactly 100% of your money. There is a solid floor right beneath you.
But when you short a stock, your maximum loss is mathematically infinite. There's no floor. And more importantly, there is absolutely no ceiling. Just let that sink in for a second before we break down exactly why that is so incredibly dangerous.
So remember the core mechanic we talked about. You borrowed those shares. You eventually, inevitably, have to buy them back to return them to the broker. So what happens if you shorted a biotech company at $100, absolutely convinced its latest drug trial would fail and the stock would tank?
But then the very next day, the company announces they just cured a major disease. Out of nowhere, the stock rockets to $1,000 a share.
Well, you don't have a choice. You are legally forced to buy it back at that exorbitant $1,000 price tag just to close your position. The absolutely crucial point here is infinity, because a stock's price technically has no ceiling. I mean, it can just keep going up and up and up. Your potential loss when shorting is mathematically infinite.
It's terrifying. A bad short position can literally bankrupt a billionaire overnight. The higher the stock goes, the more money you owe. It is arguably the most dangerous game on Wall Street, precisely because the downside risk simply cannot be quantified or contained.
Which leads us right into section 4, triggering a short squeeze. So what happens when the market decides to completely turn the tables on a bleeding whale? Well, sometimes smaller retail investors figure out that a massive hedge fund has heavily shorted a company. And these retail investors decide to fight back. They band together and start aggressively buying the stock, which naturally drives the price up.
And guys, this is where the sheer panic sets in. The whale, watching their losses rapidly approach that terrifying infinite ceiling we just talked about, realizes they are totally trapped. To stop the absolute hemorrhaging of money, the whale is forced into a mandatory buyback at literally any price. But here's the crazy part. When a whale suddenly starts buying millions of shares just to close their short position, that aggressive buying violently drives the stock price up even higher.
Exactly. Retail bands together and the price artificially skyrockets. The whales scramble to stop the bleeding, and their desperate buying violently squeezes other short sellers out of their positions, creating this insane, continuous loop of forced buying. A short squeeze is triggered. Now, from the outside, this kind of market mob mentality makes for a great Hollywood movie, right? It feels like the little guy is finally sticking it to Wall Street.
Oh, for sure. But make no mistake, underneath the romanticized underdog story, this is pure, unadulterated chaos. Participating in a short squeeze isn't investing. It is extreme, reckless gambling where the underlying fundamentals of the company just no longer matter at all.
And that brings us to Section 5, the Architect's Golden Rule.
All right. After all that frantic chaos, let's completely shift our pacing here and ground this explainer back in the tranquil philosophy of Neuro Finance. On one side, you have the frantic gambling of shorting and squeezes, but on the other side, you have the architect method.
Host A, an architect does not short stocks, ever. And an architect never participates in a mob trying to trigger a squeeze. Both sides of that equation are really just different flavors of gambling. Think about it logically. Short selling requires perfect timing and carries infinite risk. Those are two things that completely destroy absolute tranquility.
Instead, we strictly follow this ultimate neurofitness tenet. We are here to calmly own the global economy and let time do the heavy lifting. Hit the nail on the head. We do not bet on the destruction of businesses. We're not here to fight billionaires in the streets of Wall Street. We are here to reliably build wealth, methodically and peacefully. Which leaves us with a final, provocative thought to wrap up today. As you look at your own portfolio and your own strategies, are you building tranquil wealth, or are you gambling on destruction? Take a hard look at the risks you're actually willing to accept.
Thank you so much for joining us for this explainer.
We'll see you tomorrow for day 56. Stay tranquil, everyone.